Good afternoon, everyone. Good morning, everyone. This is session 9, Digital Currencies and Financial Institutions of MOOC 9 of DFIN 511 of the University of Nicosia. Welcome back, everybody. And we have a nice set of questions to get started with. As always, I'm going to start by going through the questions. I have part of one of my eye keeping an eye on the chat, and so if I manage to get through the questions and I manage to catch something else in the chat, we'll look at those as well. So let me jump right in. Let's do one that is near and dear to our hearts here in Cyprus, which is, can you elaborate on the Cyprus bail-in? Yes, in fact, I can. And then it says, a cryptocurrency operating under the rules of Keynesian economics wouldn't prevent such an instance, right? I will answer that question a little bit differently, but let me first describe what the Cyprus bail-in was. So the Cyprus bail-in was an unusual event in modern central banking. Two major banks in Cyprus, Popular Bank and Bank of Cyprus, through some lending to the Greek state and some other poor lending in Greece, and finally some poor lending in Cyprus, but primarily poor lending in Greece, had a capital shortfall, a significant one. And the capital shortfall means that the assets on their books were less than the liabilities on their books. For people who haven't thought too much about banking, assets and liabilities for a bank are a little bit opposite of what you expect them to be for a consumer. So the assets of a bank are the loans that they have lent out, and the liabilities are, among other things, the deposits that people have placed with the bank. So if I'm a consumer and I have 100 euros and I deposit it at the Bank of Cyprus, it can be confusing, and you might think, oh, well, that's an asset, that's not a liability. Well, it's an asset for me, Antonis Polemitis, because I have 100 euros. It's a liability for the bank because the bank owes me that money. I can go to the bank and say, give me 100 euros. So the bank has to put on its balance sheet a liability that it owes me 100 euros. So a bank balance sheet is going to show on their liabilities and shareholders' equity section their preferred lenders, people who have lent them money institutionally, their unsecured depositors, people like the depositors, people like me, and the shareholders at the bottom of the capital structure. So when the Greek government defaulted on its loans, the Cyprus banks had lent a lot of money to the Greek government, so they had a big reduction in their assets. They had further reduction in other loans they had made to Greece and other loans they had made to Cyprus. And so eventually the Central Bank of Cyprus and the European Central Bank looked at the balance sheets of these banks and said, well, your assets are less than your liabilities. We have to correct that. And when people have a small gap there that are reasonably healthy, they might go raise more equity capital. Well, nobody was willing to invest by this stage in the Cypriot banks. Another thing people could look at is saying, well, we are going to haircut the official lenders, the preferred lenders to the bank. Well, there weren't very many in the Cypriot capital structure. Cypriot banks were funded primarily by deposits, and before the Cypriot bail-in, that was actually viewed as a very positive thing because depositors tend to be sticky, whereas lenders tend not to be sticky. So if lenders think a bank might be in trouble, they might stop lending to the bank, whereas depositors tend to be more trusting and more loyal of their bank. And so the Cypriot banks were viewed as fairly safe for having most of their funding from depositors. So given the size of the reduction in value of the assets of the banks, there was, I guess there's a fourth source that happens very often, which is the state steps in and says, I am going to inject capital into the banks. I'm going to nationalize them and become effectively a shareholder or a creditor to the banks. And this happened in the United States. This happened in the UK. This happened across many banks in the European Union. This could not happen in Cyprus, given the size of the banks relative to the size of the Cypriot economy. So the banks in Cyprus are quite large relative to the size of the Cypriot economy. So the Republic of Cyprus could not have gone in and said, the banks were short about 10 billion euros. They did not have 10 billion euros to come in and inject into the banks. Well, at this point, the EU did something that has not happened in modern times in developed countries, which said, we are going to haircut the depositors. And it is technically correct at some level, but just very rarely done, because they are the most innocent parties in this whole affair. Because when you're a depositor in the bank, in any bank, you're effectively lending money to the bank. And so when you're lending money to a bank, just like if you're lending money to your cousin, you should be theoretically assessing their creditworthiness and saying, is it reasonable for me to lend money to them? Will I expect that I'll get my money back? Now, in practice, no consumer does this for any major bank. You assume that the central bank who's regulating them will keep an eye on these things and not let a bank operate if it's unsafe. And it's quite unfair, I believe, to expect that an average Joe who has to deposit their paycheck somewhere also needs to become a bank credit analyst to make that decision, because figuring out if a bank is solvent or not is a very, very complicated question that even central banks get wrong. So Joe, random employee somewhere who needs to deposit payroll, that it's impossible for them to really understand this. But the EU took a very strict view and said, no, they should have known. They were getting highish interest rates, and we are going to haircut their deposits. In other words, pay them, reduce the bank's liabilities to depositors. Okay? Reduce the bank's liabilities to depositors so that the bank balances come back into line. And what ultimately was decided was above 100,000 euros, which is the deposit insurance limit in the European Union. In Popular Bank, 100% of the balances were gone. And in Bank of Cyprus, about 50% of the balances were gone. Now, this might not sound terrible at a first approximation, because you say, well, 100,000 is a lot of money. But keep in mind that this is not just people's checking accounts. This is savings accounts. This is retirement accounts. This is accounts of businesses, large, medium, and small. The University of Nicosia, among many other businesses, had money that was haircut there, because we obviously have more than 100,000. We have obviously more than 100,000 euros in our bank account at any point in time. And so on and so forth. And so one day, and these two banks were the major banks of the Cypriot economy. And so these banks, one day you wake up, and if you had, let me say you were a customer of Popular Bank, if you had 100,000 at Popular Bank, the next day you still had 100,000 at Popular Bank. If you had 500,000 at Popular Bank, the next day you had 100,000 at Popular Bank. If you had 10 million at Popular Bank, the next day you again had 100,000 at Popular Bank. And so this was very traumatic for Cyprus and very unusual. I believe it would have not happened if Cyprus wasn't a very small country in a very large currency zone union. There is no, generally what happens is the state will put money in, or if it doesn't have the money, will print money to inject money and say, it's better to have a little bit of inflation, have a little bit of currency depreciation, as opposed to saying all of a sudden from one day to the next, for no particular fault of any particular depositor, hundreds of thousands of people have their savings wiped out. And Cyprus was used this way. I'm seeing this in the comments. It was a little bit of a test case because we were small and we wouldn't cause any systemic risk to the European Union as a whole. And not just test case as I'm testing things. Test case to kind of make the point of, hey, you know, we don't want because could the European Union easily afford to bail out $10 billion for the Cypriot banks? Yes, it's trivial. And it's a rounding error of a rounding error at the European Union level. But there are much bigger countries like Italy that have a shaky banking sector. And countries like Germany don't want someday to be on the hook for the Italian banking sector. So they're trying to set a principle that problems in a banking sector will stay within a national capacity. So with that as background, and I know it's a little long, but I don't think there's any other way to understand it. Let's ask ourselves what this has to do with cryptocurrency, really. And the answer is not very much. Here's one analogy there. Cryptocurrency is cash. Okay? So cash, you cannot have fractional reserve on cash, right? Like if I'm holding a $20 bill, I either have a $20 bill in my hands or I don't have a $20 bill in my hands, right? I can go and give it to you, and now you have a $20 bill in your hands. That's what a Bitcoin is. I have a Bitcoin. I can show you my Bitcoin. I give it to someone else. Now they have the Bitcoin. The Bitcoin is in one place at a time. Your $20 bill is also in one place at a time. When you take your $20 bill and take it to a bank, and you give it to the bank, you no longer have a $20 bill. What you have is you are now a creditor of the bank. You have lent the bank $20. The bank now has $20 as a liability. The bank has borrowed $20 from you. And then the bank has to decide what they're going to do with the $20. They could just keep it around and, you know, naively people think, oh, great, my $20 are there. They're in the safe somewhere. But then it's kind of tricky because how's the bank going to pay for bank employees and bank branches and advertising and all those things? So what they typically do with your $20 is take the $20 and lend it to someone else, and ideally lend it for a higher interest rate than they're paying you. And banks will make money on the difference between those two interest rates. So if banks borrow from you at 1% and lend to your neighbor to buy a car at 4%, the difference between the 4% and the 1% is 3%. That's known as the net interest margin. How banks make a profit, and then they have all their other expenses. You know, they also charge you, fees for bounce checks and opening accounts and all those things, but that's not the core business that they're in. Core business is borrowing money and lending it. Well, in theory, you could do the exact same thing with Bitcoin. So let's say I wanted to open the Antonis Bank of Bitcoin. And I said, I am offering interest rate of 5% on Bitcoins. So send me your Bitcoins. You will send me 5 Bitcoins. I will owe you 5 Bitcoins. And in fact, I'm going to owe you 5 Bitcoins plus 5% of 5 Bitcoins. So in a year, I will pay you 5.025 Bitcoins. You no longer own a Bitcoin at that point, right? What you own at that point is an asset that you have lent out. You've lent out to me, so you own a loan. And then I take that Bitcoin and I say, hey, does someone need a Bitcoin? I'm going to lend it to you for 10%. And so I'm going to go to Bob and say, hey, Bob, do you need a Bitcoin to do something? Sure. Oh, great. I'm going to give you a Bitcoin, or I say 5 Bitcoins. Maybe 5 Bitcoins. And in a year, you'll pay me 5.5 Bitcoins. Bob goes off and does his things. And then a year later, I come back and I say, hey, I need my 5.5 Bitcoins. And Bob says, yes, sorry, I lost them. I was going to invest them in a lemonade stand. Turns out there wasn't any lemons this year. People don't want to buy lemonade. I spent the Bitcoins. I'm getting money back. Sorry, I can't pay you anymore. So Bank of Antonis has failed in its first loan. I didn't get back the 5.5 Bitcoins that I hope to get. And so now when you come to me and say, I would like my 5 Bitcoins back, I'm like, yeah, I've got a problem. Sorry. I don't have 5 Bitcoins to give you. So you hear people say that you can't run this type of Keynesian or fractional reserve, whatever people call it, banking with debt-based monetary systems with Bitcoin. On the whole, people are a little bit confused when they say those things. Because what a banking is what I just described. And you could do it with dollars. You could do it with Bitcoins. You could do it with gold bars. You could do it with tulips. You could do it with anything. It's someone who is borrowing from certain people and lending to other people. Now, I know there's a whole more to this, and there's central banks and lenders of last resort. I know all that. But the core of what a bank does is that. And there's nothing stopping someone, other than the fact that I think there would be zero demand for it right now, for doing that in cryptocurrency. I don't think anyone would be happy to lend their Bitcoins for any remotely reasonable interest rate. And I'm not sure anyone would be interested in borrowing Bitcoins at the interest rates that there have to be to get people to lend them to them. So you have a takeaway here is think of Bitcoins as cash. They're a bearer instrument. And think of a bank as someone who's borrowing and lending that cash. And so it could happen just the way it is now. And so when people say you can be your own bank, it's not really right, okay? And say like, oh, with Bitcoin, you can be your own bank. It's not totally right. Being your own bank, what banks do is borrow and lend. I don't think that's what they mean when they say, let's be your own bank with Bitcoin. What people mean there is you can store wealth in a Bitcoin wallet and make payments. And yes, you can do that with Bitcoin. You can also do that with cash, but not very conveniently if you want to do electronic transactions. Right? And so thinking of Bitcoin as electronic cash tends to be a very clean framework to think about what you can do with it and what you can't do with it. And, just like with cash, to complete the cycle, do you have deposit insurance on cash? No, you don't. If I have 100,000 in my wallet and I lose my wallet, I cannot call the European Central Bank and be like, hey, I have a problem. I lost 100,000. It was in my wallet. Now it's gone. Could I please trigger my deposit insurance? You'll get laughed at. And it's the exact same thing. If you lose your private key and someone steals your Bitcoins, there's also no kind of central insurance place to call and get your Bitcoins back. And it makes sense because you can't actually, for something that's a bearer instrument, it's impossible to do that type of thing because the incentives then would be for everyone to abuse it. Imagine if you could go somewhere and say, I lost some cash, can I get it back? Everyone would be losing cash all day long, right? And so This, I think, is fundamental. That's why I spent so much time on it, because it is kind of the base of how you build up thinking about financial institutions being built on cryptocurrency. You have a bearer instrument, a cash-like instrument that is electronic and programmable. And I'm using Bitcoin as an example here. It works as an example. You can substitute whatever coin of your choosing, but the example works fine with Bitcoin. And so you have this electronic bearer instrument that is programmable, that allows you to send payments around the world, and micropayments and programmable payments that cash doesn't allow you to do. And you can imagine now people building layers of financial institutions on top of that, in the same way that the financial system works today. Because a huge amount of confusion is people mixing layers. Now, when people say, for example, oh, well, look, one of the advantages of credit cards is you can reverse charges and get points and what have you. It's true. But credit cards are a layer 2 system. You could build a credit card-like system, on top of cryptocurrency. Because credit cards, you're not dealing with any bearer instruments. You're just dealing with agreements between parties, merchants and the credit card networks in that case. And so you could do something like that and say, like, yeah, people can in fact dispute a charge and blah, blah, blah. So when you really grok that and understand it well, I find it's very clarifying. It's very clarifying when you read about proposed business models and what people think they're going to do with cryptocurrency, what they can do, what they can't do. You're very confused sometimes about what's the right comparison to make. So the comparison is, my opinion, is cash just electronic. And so if you start with that, the rest starts to make sense. Okay, I have spent a lot of time on that question, but I thought it was a helpful one for that reason. Next question. Some areas seem at high risk of disruption, remittances, payments, and others less so, corporate finance, sales, and trading. What's your view on what will survive as is and what will change dramatically 5 years from now? That's a very good question. Remittances and payments, for a variety of reasons, only one of which is cryptocurrency, I believe their margins will go down over time. And they're not going to go down to email-like levels because remittances and payments are regulated. They're money transmission businesses. And so governments tend to impose a variety of know your customer and anti-money laundering requirements on different variations of these businesses. And those things cost money. And verifying a customer costs money. So it's not going to become like the web or like email for major payments. Maybe you can do it for micropayments. But on the whole, I think margins will come down there. And not just because of cryptocurrency. You have companies like TransferWise who are supposedly matching consumers who want to exchange currencies across currency zones, and that they're doing it more efficiently than the big banks. So these used to be oligopoly type businesses, and they are getting, I don't know, attacked or disrupted. I don't like those words per se, but they're getting some competition from different angles. And logically, these are primarily information businesses plus a little bit of regulatory business, right? They're information plus regulation. And so what that means is they should be cheaper than they were 5 and 10 and 15 and 20 years from now. Now, it doesn't mean necessarily, question mark, will total profits go down? Will total revenue go down? Will total volume go down? I don't know. Volume might go up, actually, right? Like, if you remember telephony used to be very expensive, and so people didn't do very much of it. 20 years ago, 25 years ago, calling Cyprus from the United States was $2.50 a minute. Oh, when it was $2.50 a minute, I'd call my grandfather for like 3 minutes, and that's $7.50. That's a lot of money, and then that's it. You move on. Now, when telephony is free, you can just sit on Skype and chat for an hour. So there is clearly some supply-demand curve that's going to play. That take remittances are horrifyingly expensive for the relatively low-income people who tend to make them. They can be 8 to 10%. They can be 8 to 10% of the cost of the remittance. At which point, you're going to bundle into one remittance. If you drop that price dramatically, maybe people would send smaller amounts of money more often to more people, and so on. So these are the types of. So I think it's fair to say, though, not because cryptocurrency is going to take over everything, but because overall prices of remittances will go down. Prices of remittances will go down. I think that's for sure. Payments will go down also. Payments tend to go down fastest when governments take regulatory action. So banks tend to drag their feet on all this. And then at some point, the government say, look, you got to make payments happen quicker and cheaper and what have you. And the whole industry moves at once. Now, the other items are corporate finance. Yeah, corporate finance refers to helping companies issue bonds or do acquisitions, or that's not changing due to cryptocurrency anytime soon, because about 0.0001% of the work in, let's say, a bond offering or a merger has to do with transferring the money. That's trivial. The work is analyzing the company, convincing investors, doing modeling. None of that's impacted at all by cryptocurrency. Sales and trading is interesting. It's probably, again, it's no time soon in any meaningful quantities. But what you will see here, let me put it differently. Both of these areas, you are not going to see traditional activities disrupted. So like if big company 1 is planning to buy big company 2, is cryptocurrency going to have anything to do with that? No, no time soon. What you will see is organizations and assets being natively built on blockchains. And that's something different. And that's something quite interesting. Because what we've seen with ICOs is one very negative thing and one very positive thing. The negative thing is almost all of them in recent history are a scam. And by scam, I don't necessarily mean people are trying to trick other people maliciously. Well, there's some of that. What I do mean is relative to the status of the business, the amount of money being raised in exchange for what rights people are getting for the money that they're putting in is absurd. It was very bubbly, so a lot of goofy stuff got through. That's the bad part. The good part is, wow, we can actually raise money from around the world simultaneously in minutes in tens of millions of dollars. That's nuts, right? That's nuts. That's new. And so I look at ICOs and I'm simultaneously super negative on most of the current crop of ICOs and super impressed that we are seeing a internetization of corporate securities, right? Because these are corporate securities, and so the rules are going to eventually come in place to treat them, in many cases, around corporate securities. But the idea that you can fundraise internationally, quickly, directly, that probably doesn't go away. That is going to exist in some form. And the idea that you will have organizations that are more decentralized, that are trading tokens among themselves, yeah, that's also interesting and is going to exist in some form. And so this, once you get to the more sophisticated usage cases, I think it's less going to go replace things that are happening, and more it will create new usage cases that didn't exist before. And that's always where the action is in technology, right? Like even the most like cliche example, did email replace the post office? Well, I mean, yes, and primarily no. Right? Like, okay, did email replace certain pieces of mail that used to go to the post through the post office? Yes, some business correspondence that you send by mail, a postcard that you sent on your holiday. Sure. Did it replace package delivery? No. In fact, it increased package delivery. But mostly, it created a whole bunch of communication events that never existed. Right? Are completely implausible. Nobody used to go, I don't know, I get 400 or 500 emails a day. Probably send a couple hundred emails a day. It's not like when we had the post office, I would go and drop 200 letters off at the post office every day, and now they've been replaced with email. Right? There's a whole new set of usage cases that didn't exist before. And I think that's what you'll see. So there will be M&A bankers doing M&A banking things at big investment firms for a long time, but you will also see more crypto-centric, decentralized-centric financial institutions or corporations, and where trading or fundraising is going to happen in a very different way, even if the way that that's going to happen isn't clear yet. And so the I think that's how it's going to play out. The things that might be pressured most directly are the very basic things, remittances, payments. And then the other stuff is going to be the more interesting other stuff. What type of software structure could be used to integrate digital currencies and a payment system such as PayPal? It is trivial. Any type of digital currency is just a piece of software. Take a wallet, take a Bitcoin wallet, right? In a Bitcoin wallet, it's a piece of software you can go and download for free and insert it into any type of other software. And so, of course, you need to build security and user interface and all those things, but you don't need any type of special software structure. That's what's interesting about it, that you can embed effectively a wallet, a payment mechanism, without anyone's permission into anything that has software, which is now effectively anything, both computers, but any types of devices are basically now software. A car is 100 million lines of software code, right? So yes, you can integrate digital currencies and PayPal. You can also integrate digital currencies and a Chevrolet, right? Like there's nothing stopping you conceivably from, I mean, other than the fact that I'm not sure this will be that exciting, but conceivably from having a Bitcoin wallet in a Chevy and gas stations that accept Bitcoin and your car paying that. I mean, it's a little silly. I don't think anyone's going to do it, but you don't need any type of special software structure. Do you think a decentralized solution for insurance claims could arise from motor accidents, or will human judgment always be required to some extent? So we teach a class called Open Financial Systems, and we have a chapter called Insurance. And this is one of my, not pet peeves, not exactly the right word, but one, I'm always intrigued when people say, we're going to do a crypto or decentralized insurance company. Because an insurance company is a bunch of different functions, some of which are not addressed by cryptocurrency, right? Like one of the functions, the one mentioned here, is claims processing. So claims processing means you've had some incident has occurred or is alleged to have occurred. That is an incident that has to do with an insured risk. And the claimant thinks that the insurance company owes the money. That's fine, right? It's totally normal. Now, what does cryptocurrency have to do with this? As far as I can tell, nothing. There might be automated claims processing at some point, but if there's automated claim processing, it's because of things like machine learning. It is not because of things like Bitcoin. Once you have the automated claims processing, sure, could you, once you have automated underwriting and automated claims processing, could you fund insurance contracts and pay out insurance contracts with cryptocurrencies? Yes. But that's assuming away the hard part of the whole question, as far as I can tell. All right, now, there's a company called Lemonade that is doing something like this, where they are, for small claims, doing both doing underwriting and claims processing using some machine learning algorithms and making the claim quickly. And it remains to be seen if this is a long-term exciting model. Clearly, there will be more. It'll start with small claims. Right? If we insured a building on campus and then it, God forbid, burned down, and we went to our insurance company and said, you owe us $5 million, pretty sure they're going to send someone out to check that the building did in fact burn down, and in fact a lot more than that. They're going to request an investigation and see why it burned down, and did we do something wrong, and was it deliberate, and then. I don't see any short-term way that goes away. So for maybe small claims, let's say I've claimed to lose my iPhone while traveling and I have travel insurance, and yeah, that's the type of things that Lemonade will do, and say they'll look at a bunch of risk factors and say, look, this guy's probably not lying, and they'll pay the claim instantly. The reason I'm saying it remains to be seen how these work. Obviously, in the base case, this works fine. The question is, will the savings from doing automated claim processing be lost or not lost from people trying to game the system? Because any system that automatically pays out money to people based on automated facts, people will try and game it. Right? People will say, like, oh, maybe I can trick the system. And if they find a flaw, they'll take advantage of it. And maybe they won't be able to. Maybe it's been thought through well. I don't know. I haven't tried to game it. But I think that's the tough thing in insurance. It's another one of those where paying out the money isn't particularly difficult. The big part is how much money should pay out. And then there's an interesting question of, could you have a decentralized Lloyds and use cryptocurrency just for the funding of risks? So keep everything else kind of humanly oriented. Like, here's a bunch of different risks. And we're looking for people to insure them. And we are going to crowdfund the people who are going to take the other side of those contracts. Well, interesting question. It's an interesting question. But insurance I put among the harder ones to automate and decentralize. Right? If you're going to fully decentralize, something's going to be fairly automatable. And that's in the harder buckets, I think. Okay, companies like 10x let you deposit cryptocurrency on their credit card and spend it as fiat. Is this a step in between consumers and merchants not going in and out of fiat? What do you think of the concept of involving a third party in a peer-to-peer payment like this? In the case of 10x, the card issuer had a problem and all the cards got useless overnight. I have to say, I'm not a big fan of these business models. They seem to be like a solution looking for a problem, right? Like, if I want to spend on the Visa network, why do I need to do it in a cryptocurrency-backed credit card? And in a credit card in particular, it really makes no sense to me, because a credit card extends credit to you, right? Because someone might say, well, yeah, I want to be, let's say you are absolutely dogmatic on this, right? I want to be 100% Bitcoin in my life. I don't want to have any exposure to the US dollar. Which, and I'm going to get in trouble with some people. A little weird thing to say, because, a little weird. But even if you wanted to do that, you could hold money in cryptocurrency, spend on a credit card. When the time comes to pay the credit card, sell some money on exchange and pay it off. And then you'll have a perfectly normal Visa credit card, which will do all the normal things that a Visa credit card does, with 0% likelihood of what has happened over and over with these things, that someday the card networks decide they don't like this anymore, and then they freeze all the cards. And you're still 100% crypto exposed from an asset perspective. So I don't get this one, right? Like, crypto for payments to me seems to be relevant for payments that you can't do with a credit card. And that's not definitionally not the payments that you can't do, because all of these, none of these crypto for credit cards have actually gone and built a crypto-based merchant network, right? They're all running on the existing credit card networks. So I don't get these. I don't actually get. I think they're marketing initiatives as opposed to anything. They're actually solving any problem. Would Bitcoin futures and ETFs require similar regulations? Not really. One is an institutional financial product. Futures, ETFs tend to be more retail oriented. They're different financial products. They both have a vast array of regulations they are subject to. And so other than the most abstract level of Yes, they're financial products and they have financial regulations associated with them. They don't have that much in common, regulatory-wise. Next one. What is the purpose behind BTC futures and derivatives besides shorting and a sort of gambling? I think the question is, why do futures and derivatives exist? And it is a variety of reasons. Like with all financial products, some people use them to reduce their risk. Some people use them to increase their risk. And risk and reward go together in this topic, right? So we have, so what do I mean reduce risk and increase risk? Let's say we have I know in a month I am going to owe someone 100 Bitcoins or 100 barrels of oil. I might not want to be exposed to the price volatility between now and then, because I want to lock in the economics of this transaction now. So I use different forms of derivatives. All of these are somehow derivatives. And I lock in the cost of me delivering 100 Bitcoins or 100 barrels of oil in a month. And I lock it in now. Now, maybe okay, for me to do that, there has to be someone on the other side of that transaction. And maybe that person is the dreaded speculator, a gambler. How do you distinguish between that and a natural, someone who wants it for non-speculative purposes? Right? You can't really. And that speculator is providing me, the non-speculator, a service, right? Because if I say, I want to buy today at $800,000 future delivery of 100 Bitcoins, I need someone willing to sell me 100 Bitcoins in a month from now and take the other side of the price risk, right? And by taking the other side of that price risk, that person can make money if transaction goes their way, or lose money if the transaction goes the other way. They're a speculator. But so what, right? Like, that's what makes markets. And so this idea that you hear commonly in cryptocurrency, that we're going to have financial markets, and we just want people whose trading intentions are pure, is an illusion. It's a daydream. It's not real. There's no mechanism to figure that out, right? Like when you go buy a share of IBM stock for your retirement account, are you a speculator or are you an investor? Then change your mind and sell it because you heard some bad news about IBM. Has it changed anything? Before you were going to keep it for 10 years, but it turns out you sold it the next week because IBM had some bad news. Have you changed from an investor to a speculator? What if you wanted to take 100 euros and not buy one share of IBM, but buy a call option to buy 10 shares of IBM above this price in a month? Are you now a speculator? In all cases, you are taking some type of positive or negative view on the direction of some financial asset. And sometimes you have a natural hedge in your own business, right? Like you're producing gold and you know you're going to cost you this much to produce gold, and you unlock the price of the future price of gold. And sometimes you're just there for financial purposes, but I don't think it makes any difference. It's certainly not one's more moral than the other. And you need markets, you need counterparties to make a market, right? So this is very interesting. You need counterparties. Like, have you ever thought about like how markets are reported? Why did the price go down? There were more buyers than sellers. Well, kind of, sort of. I'm sorry, there were more sellers than buyers. Kind of, sort of. At the old price, but not at the new price. Because if I'm selling, for me to get a price, someone else has to be buying. There's always a buyer and a seller in each transaction. Now, the price goes down because, let's say at $100, there were more sellers than buyers. But then at $90, where the price ends at the day, there were both sellers and buyers. Right? Because were transactions. So any trade you do, there will be someone on the other side of that trade. And so if you think you're being very smart by selling or buying or doing an option to sell or buy, there's a counterparty who thinks the exact opposite thing, thinks they're getting the benefit by doing the exact opposite thing of what you're doing. And so it is very, very silly to worry too much about why people are in markets. Instead, it's generally good for there to be lots of people in markets, because then you have liquidity. Then prices become smoother. You have more ability to sell or buy at the price that you want if there's more counterparties on the other side. So the reason between futures and derivatives in Bitcoin is the same reason as futures and derivatives everywhere else. So both for natural hedging and financial investment, speculation, whatever you call it, but arguably it's all kind of the same thing. Okay, we have come to the end of the session. I want to thank you all again very much. I hope you have a very nice weekend, and we will see you all again next week. Thank you, everyone.